Good morning, everyone, and welcome to this week's market update. My name is Salome, and today I'm joined by my colleagues Astgik, Sophie, Varduhi, and Henrik. Together, we'll review the latest developments across commodity and financial markets, explain how they fit within our macroeconomic framework, and conclude by sharing some of our latest research on global supply chains and geopolitical risk. I'll begin with another week of significant volatility across global markets. Although the daily headlines have shifted repeatedly, the broader macroeconomic picture has remained remarkably consistent. Markets continue to react rapidly to geopolitical developments, inflation concerns, and central bank communication, while investors struggle to distinguish between temporary news and longer term structural changes. Over the past week, we have again seen large swings in energy prices and financial markets as geopolitical tensions continue to evolve. Headlines alternated between escalation and de escalation, driving sharp movements in oil prices, government bond yields, and equity markets. These reactions highlight how sensitive markets remain to uncertainty surrounding global energy supply, trade, and inflation. What is particularly important is that these developments are not simply commodity market events. They are potential supply side shocks that could influence inflation, economic growth, and ultimately monetary policy. In this environment, central banks face increasingly difficult trade offs as inflation risks remain elevated while growth prospects become more uncertain. Last week, this was reflected in the market's reaction to recent Federal Reserve communication. Investors interpreted the discussion as signaling greater uncertainty about the future policy path, producing a steepening of the yield curve as longer term yields rose while shorter term yields declined. Whether driven by higher inflation expectations, a higher term premium, or a combination of both, the reaction demonstrated an important point. During periods of elevated uncertainty, policy credibility becomes just as important as policy decisions themselves. One important change this week is not simply what has happened in markets, but how we interpret those developments. Financial markets often react to the latest headline. Our objective is different. We ask whether new information changes the balance of risks facing the global economy. As geopolitical developments, energy markets, and monetary policy evolve, our assessment of the probability of different macroeconomic outcomes evolves as well. That brings us to the framework that guides all of our analysis. Rather than attempting to predict a single future, we organize the global economy into a small number of coherent scenarios that capture the different ways today's shocks could develop. Every major development in commodity markets, financial markets, and monetary policy can be understood within this framework. To explain how these probabilities have changed this week, I'll now hand over to Askik.
Thank you, Salome. Our analytical framework begins with four broad macroeconomic scenarios that combine different paths for economic growth and inflation. Rather than asking which single forecast will materialize, we ask which economic environment appears most likely given the information currently available, and how those probabilities change as new evidence emerges. An important aspect of our approach is that we do not estimate these probabilities mechanically from historical data alone. Historical relationships provide valuable context, but today's geopolitical environment is unlike anything reflected in most statistical datasets. Instead, we combine economic evidence with forward-looking judgment, asking how current developments change the distribution of possible outcomes rather than assuming the future will simply resemble the past. This week, that assessment has changed. Although financial markets have become more optimistic following recent de-escalation headlines, we believe the underlying structural risks have not disappeared. Energy markets remain vulnerable, supply chains continue to face uncertainty, and inflation risks remain more persistent than markets currently expect. As a result, we have adjusted our scenario probabilities. We now assign a 25% probability to a productivity boom, where technological progress supports stronger growth while inflation gradually declines. We continue to believe that artificial intelligence and productivity improvements will become increasingly important over the medium term. However, we now see this scenario as less likely to dominate the outlook over the next 12 months, given the growing importance of near-term geopolitical and inflationary risks. Instead, we have increased the probability of an inflationary boom to 35%, making it our central scenario. In this environment, investment and economic activity remain relatively strong, but inflation proves more persistent than markets currently anticipate. continued investment in artificial intelligence, resilient labor markets, fiscal expansion, and the possibility of renewed energy pressures all contribute to inflation remaining elevated despite solid economic growth. We continue to assign a 30% probability to stagflation. Although this is not our central scenario, we believe markets continue to underestimate the possibility that supply-side disruptions could generate slower growth alongside persistently high inflation. Renewed geopolitical tensions, disruptions to energy markets, or broader supply chain constraints could all push the global economy in this direction. Finally, we assign a 10% probability to a demand-driven recession. While downside risks certainly remain, continued investment, particularly in technology and artificial intelligence, continues to provide important support for economic activity. As a result, a conventional recession driven primarily by collapsing demand appears less likely than either an inflationary expansion or a supply-driven stagflationary environment. The purpose of this framework is not to predict exactly what will happen. It is to organize uncertainty in a systematic way and update our assessment as new information becomes available. To explain the latest developments across the major regions of the global economy, I'll now hand over to Sophie.
Thank you, Astgik. I'll now explain the key regional developments that have shaped our updated probability assessment this week. Although the headlines have evolved, the main economic forces remain broadly consistent. The important question is not whether risks exist, but how they affect the balance between our four scenarios. Let's begin with oil markets. Our scenario framework remains unchanged. Prices continue to respond sharply to developments surrounding negotiations with Iran and the security of shipping through the Strait of Hormuz. Oil has traded within a relatively wide range, while physical flows remain vulnerable and global inventories have already declined. The important point is that uncertainty itself has become the story. Our baseline continues to assume that supply gradually normalizes and oil prices remain broadly contained. However, a renewed disruption in the Gulf would still have the potential to push prices back above $100 per barrel, creating another stagflationary shock. On the other hand, stronger productivity growth and expanding investment could gradually ease supply pressures over the medium term. Recent developments have changed our assessment of the probabilities, but they have not changed the structure of these scenarios. Turning to the United States, the Federal Reserve faces an increasingly difficult policy environment. Although policy rates were left unchanged, recent communication highlighted growing uncertainty about the future policy path. Long-term Treasury yields have risen, reflecting continued concern about persistent inflation, fiscal dynamics, and the possibility that the neutral interest rate may be higher than previously assumed. Inflation has moderated in some areas, but underlying price pressures remain persistent. Combined with continued investment in artificial intelligence and infrastructure, this leaves the Federal Reserve balancing two competing risks: tightening too much and slowing the economy unnecessarily, or tightening too little and allowing inflation to become more entrenched. In Europe, the outlook remains subdued. Growth continues to be weak and uneven, while services inflation and labor costs remain elevated. Lower oil prices have provided some short-term relief, but exceptionally low Rhine water levels are once again disrupting inland transport, increasing shipping costs, and creating additional pressure across manufacturing, chemicals, refining, and heavy industry. This illustrates an important point. Supply-side shocks are not limited to energy markets. They can emerge from infrastructure constraints, transport networks, and logistics, creating slower growth alongside higher costs. China continues to display a sharp divergence between external and domestic performance. Exports and advanced manufacturing remain relatively resilient, while the property sector and weak household confidence continue to weigh on domestic demand. The central question is whether external strength can continue to offset weakness at home. If not, slower Chinese growth would represent another headwind for the global economy. Japan presents a different challenge. Recent currency intervention has helped stabilize the yen, but underlying pressures remain. A weaker currency increases imported inflation, particularly when energy prices are elevated, while additional tightening by the Bank of Japan could create further stress in bond and foreign exchange markets. Across Africa, the principal transmission channels remain energy, food prices, financing conditions, and exchange rates. Oil exporting economies may benefit from higher prices, but oil importers face rising inflation and greater external financing pressures. At the same time, higher global interest rates continue to increase debt servicing costs for countries with significant foreign currency borrowing. Taken together, these developments reinforce our updated probability assessment. We continue to see resilience in investment and technology, which supports growth. At the same time, geopolitical tensions, energy markets, and supply constraints continue to generate inflationary risks that markets may still be underestimating. With that in mind, I'll hand over to Henrik, who will explain how our latest research helps us think about these risks through the lens of global trade and supply chains.
Thank you, Sophie. Many of the developments we've discussed today have one thing in common. Whether we're talking about energy markets, inflation, or geopolitical tensions, they ultimately depend on a surprisingly small number of critical bottlenecks within the global economy. Trade operates through a network of highly concentrated routes and production centers. When one of these nodes is disrupted, adjustment is rarely smooth. Instead, it depends on one fundamental question. Is there a substitute or isn't there? The interesting part is that we've already observed this experiment, not in a model, but in the real world. For more than 2 years, commercial shipping through the Red Sea has been severely disrupted. Because almost every commercial vessel broadcasts its position by satellite, we can observe how the global trading system responds in real time. The pattern is remarkably clear. Traffic through the Bab el-Mandeb Strait fell dramatically, but the ships didn't disappear. They simply sailed around the Cape of Good Hope. Transit times increased by around 2 weeks. Freight costs rose, insurance premiums increased, and deliveries took longer. But the goods kept moving. Almost every ton that disappeared from the Red Sea eventually reappeared around southern Africa. That tells us something important. The Red Sea disruption behaved primarily as a cost shock rather than a true supply shock because the global economy had an alternative route. There was somewhere else to go. Hormuz is fundamentally different. There is no equivalent alternative for the Persian Gulf. Some crude oil can bypass the strait through pipelines, but that capacity represents only a small fraction of normal export volumes. A disruption in Hormuz would therefore not simply increase transport costs, it has the potential to reduce physical supply itself, creating exactly the kind of stagflationary shock we've discussed throughout today's presentation. Our research, however, extends well beyond maritime trade. Increasingly, the world's most important choke points are no longer straits. They're factories, rare earth processing, permanent magnets, battery materials, and critical mineral refining account for only a very small share of global trade by value. Yet they occupy positions within supply chains where substitutes are extremely limited, and qualifying new suppliers can take years rather than months. That means a material representing only a tiny fraction of global trade can still constrain entire industries, from electric vehicles and renewable energy to advanced manufacturing and defense production. So whenever someone says, it's only a small share of imports, that tells us very little about the true economic risk. There is also an important measurement challenge. Satellites can see ships, but they cannot see what's inside containers. Oil travels in dedicated tankers that can be tracked directly. Critical minerals move inside ordinary containers alongside thousands of other products. As a result, maritime disruptions are highly visible. Industrial bottlenecks are far more difficult to observe and often become apparent only after prices begin to rise or production starts to slow. This is why we've developed a common framework for analyzing supply disruptions. Every disruption is evaluated using 3 questions. First, does a substitute exist, and how quickly can it be deployed? Second, how large are the available buffers, including inventories and strategic reserves? Third, how will the disruption ultimately affect inflation, economic activity, and monetary policy? By applying these questions consistently, we can compare very different types of disruptions using the same analytical framework. The Red Sea demonstrated what happens when substitution works. Our research is focused on understanding the disruptions where substitution is limited or does not exist at all. That is where the greatest macroeconomic risks are likely to emerge.
Thank you, Henrik. Before we conclude, let me briefly summarize today's discussion. This week, we've seen that while markets continue to react rapidly to changing headlines, the underlying macroeconomic questions remain remarkably consistent. Geopolitical developments, energy markets, inflation, and monetary policy continue to shape the balance of risks facing the global economy. Rather than attempting to predict a single outcome, our approach is to evaluate a range of possible scenarios and continually update their probabilities as new information becomes available. We believe that in today's environment, understanding how risks evolve is more valuable than relying on historical relationships or point forecasts alone. Whether we're analyzing commodity markets, central bank policy, or global supply chains, the same principle applies. The key question is not simply what has happened, but how today's developments change tomorrow's risks. We hope today's discussion has provided a useful framework for thinking about these challenges. If you'd like to explore more of our research, read our latest reports, or learn more about our analytical frameworks, please visit www.thebetterpolicyproject.org. Thank you for watching, and we look forward to seeing you again next week.